This is TreppWire with a special guest podcast. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Chief Product Officer. Today we are joined by Shlomo Chopp, Managing Partner of Terra Strategies and distressed debt expert. Shlomo comes to us with more than 20 years experience in commercial real estate with roles in property tech, investments, operations, and debt restructuring. He is frequently cited in the media and has a growing followership on social media. We are excited to dig into the world of distress with you today. Welcome, Shlomo.
Thank you, Haley. It's absolutely my pleasure to join you guys.
You've always been a loyal TreppWire podcast listener, and now we brought you out to the front and for our audience. So let's start from the beginning today. What drew you to real estate and then specifically distressed real estate?
Funny, I got a job with a relative in the flooring business, and there was someone else in the building that was buying tertiary market shopping centers, a community center with a grocer with 3 years remaining at $350 a foot in sales with Aaron's Rents and other ancillary tenants. And I just was drawn to it, got into that game, just trying to broker, put deals together. And then after a few years doing some deals, making a couple of bucks, and then the downturn hit. And what do I do now? And thankfully I had an attorney who was previously at Citibank in the CMBS side of stuff. He's like, Shlomo, there's some action in the CMBS space. So as a kid who went to yeshiva, I downloaded the pooling and servicing agreements and started reading them. I never heard the word tranche before, but at the end of the day, started understanding and saying, okay, I know all these borrowers that took loans that mortgage brokers told them, oh, it's a great loan, more LTV, lower rates, whatever it is, but they didn't understand what was going on. And I said, hold on, I could actually help them figure out their problems. Got a couple of guys to give me a shot, and it's been off since then from there.
So I have a lot of questions for you, Shlomo, today. You have great experience. You just mentioned that you saw the last crisis, but could you tell us a little bit about the very first distressed deal that you did and what it was like? The first time you kind of pulled up that pooling and servicing agreement, when you went through it, what you had to deal with, and what kind of asset type were you dealing with in that first go around?
Wow. So I did that. It was a workout I did with Eleanor. One of the first ones I did. It's not the first one, I can't remember the first one, but one of them. It's a great example because it talks about how people transition from mom and pop to CMBS, and there's a huge difference between the two. A guy had a bunch of New York City multifamily buildings, sold it, and had a 1031 and decided to put that money to work in Arizona. And ultimately bought 2 multifamily properties, and it just didn't perform. Why? Because he's an absentee owner. What I was able to structure for that guy was that we were able to sell it as a receivership sale with assumable debt. Because at that time, Arizona's hot right now. Phoenix is hot, and maybe not as much as before, and people are starting to see some issues. But at the time, 1-bedroom rents went down, I want to say, from 700 or so to 300 or so a month. It was like it just collapsed. The market was tough, and these guys were just totally disenchanted with everything, and they triggered some potential recourse issues, and were able to get the lender off their back by allowing it to be sold with the debt in place. Because in the CMBS loans, once it goes REO, the lender can't do anything with it. But if it's in place and the lender could sell it with the debt, meaning the borrower sells it to a new party with the existing debt in place and it's modified, then the new borrower may pay more for it. So that was how we sort of got him off the hook on that. That was one of the first deals I done.
Can you walk us through the process of, I think for a lot of people out there, a lot of listeners out there, there's this notion, if you've never been through the process before, there's a servicer, there's a special servicer, you are the borrower, you've never done this before. Somebody like Shlomo Chopp comes in here and works through the process. Can you give us kind of a 101 on how this process works, when a borrower should bring in somebody like you, what role you play, how the sausage making, so to speak, works between all the parties in a distress situation?
Yeah, sure. So let's start with who owns your loan. Grandma owns your loan. a bunch of grandmas, a bunch of people and pensioners own your loan. You may say, let the lender take a hit. You're essentially saying pensioners shouldn't get that money. Those pensioners are serviced by fund managers, pension managers, who then own specific bonds. When they buy the bond, it's like, hey, this is a safe investment. You go to any, call Fidelity, I want to put something safe. They'll give you a corporate bond ETF or something, right? And that's who really owns your loan. But obviously, grandma's not managing your loan. Grandma's not managing your property. So they hire these people in between. Now, these people that are managing it, they're the various servicers, various intermediaries. I mean, they can't just do whatever they want. So there's got to be a list of what ifs, right? If you make your payment, that's great. If you don't make your payment, what do we do then? And that's just, the binary question of you go into default. But even on an ongoing basis, making your payment, how do funds get applied? And these are various, is a rabbit hole of issues. Multiple rabbit holes we could go down on that. So this intermediary now has a list of what needs to be done. So people listening are either traders or property owners or a combination thereof or servicers. Think of putting together a partnership agreement where every potential eventuality is written out in it up front. It's practically impossible. So what has to happen as a result is that you need to have a set of guardrails that basically say, if this happens, then that happens, and it's never going to be perfect. And then you also need to have discretion where the people that are executing have some leeway to make decisions. So if you're a borrower and you have a loan and it's starting to become an issue, you look at it one way. The guy on the other side is like, listen, I got to make my bond payment, pay your mortgage, right? And you may say, this guy's so unrealistic. He doesn't understand what's happening. The market, it's not worth the property. But screw the lender, or whatever you're going to say. It doesn't work that way, right? The lender cannot afford to take your word on what's going on. So that's the biggest disconnect, I think, from a borrower to a lender. I think from a lender to a borrower, the biggest disconnect is to a certain extent tribalism. Oh, that's not a great borrower. Oh, he didn't manage it properly. Oh, screw him. He doesn't want to put in money. We're going to go take the property. Where did he grow up? He doesn't learn he should pay his debts. And those conversations really happen. So you have this disconnect, and that's a massive issue. So what you need is to understand what makes each side tick. And it really takes a mediator, if you will, to be able to say, this is what this guy needs, this is what this guy needs. How do we get the reality of the situation out and agreed to between all the parties? And now let's figure out what each party can give and take. The problem is, for a borrower, there's a ticking clock. You have a foreclosure process going on, especially in some states where it's non-judicial foreclosure. It could be anywhere from 90 days to 6 months and you're done, right? And the problem for a lender is that they're required to, as a baseline, take over the property, put a receiver in place. And despite the borrower saying, oh, receivers are going to kill them, what should they do? Leave it with a borrower that has zero economic interest in it? So there's arguments to be made on both sides of the equation. But without a baseline of what needs to be done, even if it seems like a bad decision, everyone's going to lose.
So let's stick on that point for a second. I'm going to give you a hypothetical here. We have a situation, let's call it a $20 million loan, office space in a market that is not oversupplied, pretty good market. You lose a tenant that's 35% of the space. DSCR goes from 150 to 85, but you're the owner and you think, this is highly desirable space. I may need some time, but this is a building I want to hold on to. I believe in this building, and I think I could tenant this up again. But you're losing money. You have to reach into your pocket, and you have to support this thing going forward. What are a mistake or two that borrowers might make with a special servicer that is preventable? What's an unforced error that a guy in that situation might make that somebody in your situation would say, had I been by your side in the beginning, I would have kept you from making this mistake? Like, you had a situation where options were available, but you didn't see that they were there for you.
Putting up all your leverage on day one. Essentially, if let's say it's going to cost, if you were to underwrite this deal from today when the problem starts to the time you're able to stabilize it and potentially refinance, and you think there's $3 million to get that entire way. But instead of doing that analysis, you're like, oh man, next month's payment is $250. Okay, so let's think how many months it's going to be. It's going to be 3 months, 4 months. I'm going to put up $1 million, and hopefully then I'll find a tenant, and hopefully then, and oh, by the way, I got reserves on deposit and blah, blah, blah. Let's go through one piece at a time. You can't just solve for the issue, the triage right away. You need to think about like what's going to happen next. You may have reserves with the lender, but if you go in default, or if let's say you're past the trigger point, or with regards to some DSCR, or with regards to something that you otherwise did in the property, we're even not sure that you even triggered it because you don't even know what your loan docs say. And you may not even be eligible to take those reserves from the lender to lease it up. At that point, you're $1 million and you're like, holy crap, I need that money. You're like, well, we're not giving you the money because of X, Y, and Z. Look at your loan document section 3, and there you go. And he's can't get the money. And then he's like, forget it. The lender's not acting in good faith because I want to lease up the property. He won't give me the money for it, right? So meanwhile, you just pumped in $1 million and you're no better off than where you were to begin with, except you have this theoretical tenant you can't put it in place. When in reality, on day one, the right thing would have been to understand your loan documents. The right thing would have been to say, okay, I'm going to need $3 million. I really could only come up with 2. So let me use that 2 to get something from the lender in exchange, and maybe defer some of it, or maybe get a contingent discount, or whatever it is that you're going to get out of it. But the lender understands that there's a value to the money you're going to put in. So if you're going to go pump in half solutions and not be left with something to fix the rest of the problem, you actually just like made a huge mistake. Let's put it that way. Let's keep it at that.
I thought that was a great explanation. Lonnie, let me let you jump in for a couple of questions here.
Yeah, thanks, Manus. And Shlomo, really excited to have you on. I know you and I have kind of become friends off air, I guess. You had me on a Clubhouse interview maybe a couple years ago, and then I was on a think tank. We were talking through like how we're going to deal with offices and some of the stuff that's happening here. So it's really great to have you on the podcast, and looking forward to our listeners getting to hear from your perspective. So I think, you know, perspective is a pretty powerful word, and I think you have a unique perspective given the business that you're in and seeing the distress. So like if somebody just came across your social media or came across you in some newspaper articles or some places you've been quoted, your narrative generally is around distress, right? And so there's a lot of people that say, well, it's not all that bad, the market's still performing pretty well, et cetera. Just give us some perspective on what you're seeing that maybe others that are just looking at top line numbers around delinquency or other things maybe aren't seeing. You know, what is it that forms that distress narrative for you in today's market?
The reason I say what I say in public is because I get calls that I cannot explain to people that I get those calls. It's like, I got a problem. I got a call from my tenant, and my tenant said that they're likely not renewing. And if they did, it would be for less space at a lower rent with higher TIs. And I really don't know what to do. For now, I'm going to feed it because my investor wants to put in the capital, but what am I going to do? Those things don't reflect in a delinquency report. And the fact that, you know, even for example, that a tenant has a termination option, has exercised it, and that maybe hasn't made it to the Trepp report. I mean, those are things that the average borrower doesn't know. So the reality is it's the difference between waiting for the broker to bring a deal to market and you having a personal relationship with the owner and trying to close a deal with him if you're thinking acquisitions. I get these calls daily. Like if I wanted to take on every single project, I can print money. But the reality is I turn away at least 60 to 80% of the calls that I get because it's too far gone. There's no real leverage, or the guy doesn't have the capital, the money to pay me to do the work on the workout side. So that's something that borrowers don't see. They say, hey, you're being too negative, or other guys out there thinks I'm being too negative, and that's perfectly okay. I don't owe them anything, and I could say what I want. They could block me if they want as well. But the reality is that there's a lot of issues. There's a massive amount of issues. So, you know, I hope it doesn't materialize itself, but let's use an example, right? I got into a tiff with someone on social media where I said, I believe office buildings are going to be over 50% delinquency rate. And that guy lost his marbles. He's like, dude, you know, the high-end delinquency rate was only 12%. How are you doing that? I said, you're right. It may not work out that way. But the numbers tell me that it should be at 80. Okay? Because, I mean, it doesn't take a property to go into default to lose 100% of its tenancy. If you're leasing a building at a $30 per square foot expense load, it takes 100% occupancy at $30 a foot to be able to break even and not lose money before thinking of any debt. Right? You know, just run those numbers and pull some knobs and levers. maybe 10 to 20% vacancy increase on an office building that has a loan on it, and you're pretty close to either being delinquent on the mortgage or realizing you really got no elegant way out of this by the time your loan matures. Now, will it happen that way? Likely not. But I could see scenarios where it does get to that, right? So, but I'm not in the prediction game. I could just say this is how it looks to me.
Yeah, I think that's good. I mean, you're obviously, it's just like us at Trepp. I mean, we bring commentary to the market near real time. We're seeing things that happen as soon as this commentary is released, and we're doing our own due diligence. And you're obviously getting those phone calls sometimes in advance of what is even reported in the marketplace. So it's good to see, you know, everyone has a perspective. If you're on the investment sales side, obviously, you're opportunistic and you're optimistic because you need the markets to help you make sales. In your business, it's slightly different. So let's pivot a little bit. In addition to just doing the workout side of the business, you also have made it known that you're also, you know, invest in CMBS distress. So maybe walk us through a little bit of that, kind of give us some of the guardrails there of how you keep the two businesses separate so you don't cross any lines, and give us some insight.
Yeah, I think the first thing is I wouldn't work on anything or have any material non-public information, anything that I would trade for sure. So that's the baseline. But the reason that I'm investing on the bond side is I believe that real estate investing and trading are two different games. So for example, if I have a $100 million loan on an office building that has 100% occupancy for the next 40 years with the US government at a rate that makes sense, and I'm covering at a 1.5 coverage ratio forever, and I'm doing well, then technically you would think in the bond market that loan should trade 100 cents on a dollar or better. But the reality is if the interest rate on that is 2%, then that is going to trade at a discount. So theoretically, if I went, I bought up all the bonds in that property and I went over to the owner and I bought the property at market rate, I just bought the property at a discount. So there's this, if you look at the bonds and you look at the property and you can combine the two, not only can you find value, but you could also better underwrite the underlying bonds. So while a trader may look and say, this is my yield to maturity, I don't love it, it lags treasuries, and therefore I'm going to sell it. That's great. If I look at it from a property perspective, I look at a totally different calculation. Of course, I'll look at that calculation, but I also say to myself, is the property worth it? You could have two properties. I say this often. You could have a mid-block property with $1 million in NOI and a corner property with $1 million in NOI, and they get the same loan on it. When in reality, we all know that the corner property is always going to be more valuable than a mid-block property. There's this property component. If you really study that property component, you could actually get a leg up in the bond market to make proper investments. And that's where it becomes really interesting, given my background in property operations, my background on the workout side, and also my background in innovation. I think that's something that's bringing creative approach to the table. The fact I started out in prop tech and various other things that I've done is that it gives me the ability to say, can you drive revenue here? What can this be when it grows up? I understand office is basically, a lot of these office buildings are obsolete, but what happens in its next lifetime? And I could look at things from that perspective and then make whatever calculations I need to make from an investment perspective.
So many different ways I can take this. 3 different threads in my head. Let me take the first one, because you brought this up a few seconds ago. Offices and extremely high default rates. Let's peel the onion back on that right now. There are several reasons we could have high levels of distress. Obviously, office distress is picking up. It's gone up from about 1% to 5%. You think it's going to go considerably higher. 3 or 4 things could drive it higher, right? Lack of liquidity, lack of demand for office space, obsolescence. Of those things, what is, the biggest driver for you in your head as to what's going to drive that delinquency number higher? Is there one linchpin that you say, this is the biggest problem that office is facing right now?
I think it's not exactly what you said, obsolescence, but it's similar to that, meaning it's not that all office is obsolete, and it's not that a large chunk of office is not obsolete. What I'm saying is that you need less space to run a business. And because the market is stagnant when it comes to demand and leasing velocity, the question is how buildings will survive, but how does an owner and a capital stack survive between the point in time when a tenant either vacates or contracts to the point in time when it's defined that this building is a building that can survive long-term and they could attract new tenancy? right? And that's the key thing. So people say, oh, that's a great building. But yeah, the building will be okay. I mean, it'll be okay vacant too. As long as you put a little steam into it, you're good to go. But the real question is, how do you keep on feeding the various people coming with their hands out? The expenses, taxes, the lender, etc., right? And then even if your building is perfect, right? And even if your building only takes a small hit, that's when you get to the liquidity side of it, right? I mean, let's be real. Like if UBS is giving you loans, that's because either they have wealth money that comes into the bank that they lend out, or that's because they could securitize it. In every instance, you have a bunch of people that may, and I'm going to use air quotes, reduce their exposure to real estate because they feel real estate is scary. Why they feel real estate is scary? Because there's a lack of the definition of what the real demand in the market is going to be, what's an obsolete building, what's not an obsolete building, right? And even if you believe you know it, that's great. You've convinced yourself, but you don't lend yourself money. So that's, as far as I'm concerned, the biggest issue facing real estate today, as far as I'm concerned, is that I could iterate a website in a day. Bricks and mortar, you can't change. So you need to have the business fit the property. And the challenge is that historically real estate is a reactive industry. I have a space. Let me build it out for a tenant based on the tenant's need and let the tenant come to me and give me what that need is, as opposed to, hey, on WeWork, I have space, come lease it from me. And obviously that's, again, I don't want to bring WeWork into the conversation yet, unless you want to. But the reality is that you're not presenting an option. You're not presenting a smorgasbord. You're presenting a vanilla box and saying, what do you need? Well, you know what? All these tenants decided they don't need real estate, or many of them. Now they're coming back, but for a period of time, they decided they didn't need, which is why we had this decline in value. So a $2,000 a square foot office building may be worth $500 a foot now.
So when we were in Miami almost a year ago, we were at Crefty together, and I think it was during the NCAA championship football game, which was on the big screens around us. You and I had a conversation that Monday night, and you were quite bearish on the market in terms of valuations, cap rates going higher, lack of office demand, and so forth. Now we're 11 months later. Would you say you're more bearish now, the same as where you were in January, or have you started to see any reason to be optimistic? And is there anything in the horizon that if you said, if this happens, it would completely change my view, either to make me more optimistic or less optimistic? It's a lot of words I threw at you there, so take it any way you'd like.
Not as much as the words that I throw at you, so don't worry about that. The thing that I think has changed that gives me some optimism is that I see a lot of acceptance, okay, of what's going on. When we were together, I mean, there's a lot of people have felt, it wouldn't be that bad, etc., whatever the story is, right? Like people saying, oh, interest rates will come down because we have a election coming up or something, like these ideas, right? Because that's how people are, right? Recency bias. But I see a lot of acceptance. My problem now is over acceptance, right? There's a very fine line between distress and lack and lack of liquidity, to the point where that distress and lack of liquidity hamstrings you. Because at the end of the day, to take advantage of distress and lack of liquidity, you do need liquidity of your own, right? So people are living in the throes of the issues. So now they have acceptance, but they can't find a way out of a paper bag. And that's really the huge problem right now, as far as I'm concerned, where people like macro answers. People don't like micro answers. And the reality is they'll parrot location every day, but apparently they don't really understand what location means. They think it's asset class. And that over-institutionalization of commercial real estate has become very dangerous.
Yeah, so we had Bob Knackel on the podcast not too long ago, and he was very vocal in his understanding. If someone asks you what the market is, you need to have the data and you need to have the numbers to articulate what the value of the market is, not just, broad-based answers. So to kind of dig in a little bit, Shlomo, we had put out some research a couple of weeks ago that looked at modifications, extensions during 2023. And a couple of things jumped off the page at me. So about 69% of the modifications or extensions that had taken place in 2023 were for 24 months or less. And so when I see that, it kind of goes to what you just spoke of, where people are hoping interest rates are going to come down or the market's going to have some shift between now and 24 months to maybe recapture some of the lost value or whatever the case may be. The logical brain in me thinks, like, if I'm needing a workout and I'm in an office building and I'm the owner, I'm probably pushing for a 36-month or 48-month type of window because I'm not confident at this point the market's going to be significantly different in the next 12, 15, 18, 24 months. What are your thoughts on that?
From the ones I've seen, what struck me is that you have deals that have after mez or maybe even before mez debt loads of $1,000 a foot, approximately that amount, that are very much reliant on, let's say New York City, very much reliant on close to $100 a foot or more rents that are just extended with new capital. And the question then becomes, forget about interest rates for a second. If there's increased supply, you can't just flick a switch and put that back and re-tenant that in a short period, even if interest rates come down. So essentially, you're extending it with the understanding that you may have to put in new capital if things don't get better. So you're chasing your original investment. My problem with that is that this becomes an emotional calculation because the lender on the other side is being aggressive and saying, I'm not going to let you do a deal unless you do that because, hey, I'll just take it back and try it out myself, right? So you have all these very smart people who are making those bets, and those bets are really not paying out right now based on what we're seeing. So I'm like right away, like if it was my clients, I'd say, hell no. No way. Like during COVID, anybody that came to me and wanted to do one of these forbearance deals, almost all that I saw that were being offered required a PG on money you took out of your own reserve to put towards interest. I'm like, why does the fact that the market is going to hell necessitate you taking a PG? You know what? Just continue paying. At least you have optionality, your PG, like you're paying it out every month. Don't exacerbate the situation. And I don't understand these mods that were done. And I think it really comes down to the fact that borrowers are not familiar with how to solve problems. Not that I could have solved those problems because maybe the lender would have said, hey, we're not doing a deal with you. But putting up more money sort of seems like you're exacerbating the problem. And I don't understand it. So that's beyond my scope of expertise. But again, assuming that interest rates come down, I think is like taking a loan that basically says that if interest rates go up, then you've defaulted no matter if you made your payment or not. It's like this covenant you can't control. And there are some of those that I've seen, not directly to interest rates, but debt service coverage ratio that lead to a default. I would never encourage someone to take that type of a risk.
So Shlomo, from 2017, I'm going back to the office thing. I'm kind of jumping around here a little bit. In the mall space, we saw demand evaporate and malls went down a certain path. And there wasn't a whole lot of people throwing back the keys immediately and writing them off. There was an awful lot of, can you give me 3 years? Let me hold on to it. You get to the end of 3 years. Can you give me another 3 years? Things that we thought might be wiped out in 2018 are still kind of hanging around. Do you expect the office space to go down that path as well? Or is there something fundamentally different about offices that we should expect a different outcome than we did for malls? Both suffering a different type of erasure of demand in different ways.
I don't have a strong opinion about this other than to say that it's more palpable, I think, to a borrower to assume that office is dead than it is to assume that the mall is dead. And the reason for that is because e-commerce has its challenges and people are used to actually coming to the store. So from that perspective, borrower said, hey, listen, this is a nice little thing, but at the end of the day, retailers need stores. Initially it was denial and eventually it proved out to be right, that retailers need stores. And the big issue that happened is that it took away demand, and only the best malls have kept standing. So I think that's why we've seen some issues. I think we've also seen situations where lenders have accepted or borrowers have accepted decline and some stuff have been reset. I think on the office side, there's just way more than there are malls, A. B, hey, we all work from home at some point. The question is, can you manage employees remotely? And I think a lot of people believe you can, or at least they believe that you could sometimes have them at home in a hybrid type environment. So I think from that perspective, people are more accepting of the fact that long term, there may be an issue where office is no longer as much in demand and therefore it will not recover like some malls have recovered. And I think the last part is that very few people have been able to pinpoint what's wrong with malls other than the fact that you have e-commerce. With office buildings, I think you could argue and say, well, if I have, 9-foot drop ceilings, it's not as exciting as having something with a massive amount of amenities, and developers are actually providing and spending more money to be able to provide those amenities as opposed to a mall where it's the same thing they were providing before. Maybe they provide some more entertainment, but malls always had entertainment. What I will tell you, however, the problem with malls is that it's interior facing. In order for you to get someone to see a store, you need someone to be in the mall and look at it. no one's identified, not no one. A lot of people have not spoken about that. But you can't walk down a street past the mall and say, oh, wow, I want to go to Dippin' Dots. Unless you know Dippin' Dots is in there and you go in and you buy your ice cream. So that's something that I think is differentiation to a certain extent on that space. But that's just me, editorializing, which I guess I'm good at until proven
I got to
wrong.
tell you, Shlomo, they could put out the biggest Dippin' Dots sign outside. I'm not going into that mall. They're going to have something better than Dippin' Dots to get me to pull my car into that parking lot. That's just me.
I got a soft spot for ice cream.
Well, Manis and I, we don't go to the mall. We shop at Kohl's anyways. So let's pivot a little bit here, Shlomo. You mentioned earlier some of your social media presence. You've grown your following pretty significantly over the last year or so. What does that mean for your business? Is that a good thing? Is the social media part of your, business construct at this point? Is it really something that you kind of just do for fun to get a feel for what's going on in the market and people share perspectives? Like, what does that look like for you?
Yeah, so I think the social media thing came out of COVID for the most part. So I historically have been a grunt behind the scenes doing the work, staying to myself. I didn't go to Harvard or Yale or whatever other college you could think of. I am a college dropout, which I guess, once I'm, huge and people could say that guy was a college dropout. But the point is, I really don't have naturally relationships. My dad doesn't belong to a country club, right? I decided that this is a great path to let people know who I am before I show up across the table from them, or I show up in a meeting asking them for something. So I've kept up with it. And over time, I've just found that, hey, I'm in a meeting and something strikes me, I'm just going to comment about it, right? And from time to time, if I feel that there's a lot of noise that could be corrected, and I put out some polls, do you even know what a SNDA is? People don't know what a SNDA is. That has established some type of credibility where it's like, okay, this guy knows what he's talking about. Where otherwise, if I would ask for a meeting with somebody, they'd go through that process in some other fashion and rely on some other data point. So that's why social media has been important to me. I don't have as much time as I'd like to have for it. And at times I regret being on it, to be honest with you. But it's, it's this love-hate relationship. And for now, I think it's a great publicity tool, and I'm out there with it.
Yeah, it's great. I think you do a good job of putting yourself out there. It's tough for all of us trying to toe that line, which, oversharing or wasting too much time on there, but also seeing the benefits of real-time information dissemination and so forth. So I guess as we kind of wrap up here, I know you mentioned tech, kind of prop tech background and innovation. You have a couple of patents on the retail side. So why don't you walk us through, what your vision is for this maybe new version of retail on the go forward?
Sure. Thank you. I appreciate you asking. So the deal on the retail side of it is part of a larger mindset of real estate is no longer about providing four walls and figuring it out from there. Real estate is providing a suite of services and a reason why people should be located within what you're doing. Used right, I believe very strongly that real estate could serve to make other industries more efficient. And when you think about all the e-commerce retail side of it, the reality is that e-commerce being fulfilled from a warehouse and retail is in a store, and retail wants to use as little space as possible, but to sell as much out of it because sales per square foot is what drives retail. But hold on, what if I can have my warehouse in the shopping center, keep the store small, and have everything the customer needs on demand? So if you actually combined a robotic micro-fulfillment and a store, where the store has less product on the shelf, but enough to sell it, and at the same time, you have all the product anyone needs on hand. So they come in and say, I love that one. Do you have it in red in my size? As a matter of fact, we do. Press 2-3 buttons, and within a couple of minutes, it's there. Or you place the order, instead of coming to your house in 2 days, it's literally in the pickup window right there. Or if someone wants a return, they come to return to store, which ends up being that they see what else is in the store and you could do an exchange, as opposed to spending money on shipping, spending money on acquiring the customer online, where it's like you're in a huge distraction where everybody sees everybody else and you got to try to get the focus on what you're doing. So all in all, what happens is they have a smaller store doing more sales because you have all the product there, which means you have way more sales per square foot. which means in your store, you could actually, in your shopping center footprint, you could fit way more tenants because you have way more stores. They do much more sales because all the product is on hand, and you cut out the shipping issues, you cut out customer acquisition issues. So pretty soon, a network of shopping centers is a network of e-commerce and retail stores where previously you charged maybe $40 a foot and you were doing 10% of sales as rent, where now you could charge $100 a foot and you're charging maybe 7% of sales as rent. And you know what happens then? Then your property has way more income. Then your property has way more value. Then your refinance is way more. And it's just a question of how do you allocate that revenue to be financeable, to be able to make that profitability. So there is a path, a very clear path. And I know Prologis has done it on their side where they've added services where if you could be more than just a disinterested landlord and waiting for the tenant to come to you, you actually provide a better service, then you could actually drive your revenue, drive your values, and take that next step in real estate.
Yeah, I think that's very interesting. I was on a call this week, and the question I posed to the other person I was speaking with is, how long do you think it is until we actually start seeing hotel branded office buildings? Because if you look at the office experience, everyone's trying to make it feel like a hotel, common areas, amenities, fresh air when you walk in so it smells nice, reception areas, et cetera, et cetera. And, they didn't really have an answer. And I don't know if that's actually going to happen in practice. But if you look at some of these new super high-end Class A offices, the reason they're doing so well right now is that it's an experience for the tenants beyond just the four walls or cubicle or whatever it is that they actually work out of. So I think it makes sense. And I think the retail side will be very interesting to your point that last mile distribution's become a huge topic of discussion. Amazon's trying to fulfill that. But if you could just do it on premise, that makes for a very interesting, I think something we'll be waiting to see who is the first mover on the retail side. You mentioned Prologis had done some stuff on the industrial. Be interesting to see what happens on the retail side for sure.
Well,
Sure.
I, for one, would love to see Shlomo disrupt Jeff Bezos. How cool would that be? See him on the front page of the Post with a 70-foot yacht and traveling around the world. I'd be the happiest guy in the world.
Well, whoever does it's going to have to come through me and my 3 patents first. So we'll figure that part out. But, Lonnie, to your point you're saying before, I mean, think about it like this. If you travel right now for business, let's say you go to New York City, right? You're based in Dallas, you come to New York City. And you have your 2 meetings and you're done with the day. What are you doing? You go back to your hotel, you sit down at the desk at the hotel, you sit down in the chair, and all of a sudden the chair falls entirely back. Like, okay, great. You finally sit down, you're there. My screen is tiny. How do I hook it up to the we work together with hotels, seems to be like a Regis hotel, seems to be for the business travel and makes sense as well. Okay, let's think the next step. If people work remote, is there a way for me to have fractional tenancy across properties in every market that as my people travel, they could plug in and have access to my systems, and it's as if they're there already, right? Can I have a roving work? There's so many things that could be done technologically that the market's just not been prepared for, or it hasn't made themselves ready for. So there's a whole new next step. And I think the unfortunate part of innovation is that the legacy stuff goes totally garbage. I mean, it's just totally antiquated, and the next level pops up. So it's less about your curtain wall, it's less about your ceiling heights, it's more about your technological integration. But it's not easy because when you start going full tech, then you deal with the hackers. Then there's so many things you need to account for that the problem that we've seen with e-commerce and some of these startups, and I think there's something that real estate needs to be careful as well, is that people get over enthusiastic with the innovation, call it Bitcoin or whatever it is. And they think that's the be all end all. And then it collapses and then people get conservative again. And you get this total movement of wealth and money that goes around, and it's all just going in a cycle. Everybody spins their wheels. And therefore, someone's got to think about this in a real fundamental way. But that needs to come from the banks. That needs to come from the financing guys. And that needs to come from the servicers. And that needs to come from the original lenders. What, as a borrower, are you doing to innovate your asset? How much money are you going to allocate towards innovation? How do we make sure you get this done right? But no one cares. Why? Because they just want to put out money and make a fee. And that is a fundamental problem. And until we solve that, which I don't think there's any good way to solve it because the parties just don't have the interest in doing it, I think we'll continue having these booms and busts over and over and over again. You got to wait till the right person comes along to do something.
All right, I'll give you one more, Shlomo, to close it out with, just to round it out. Heading into the new year, give us one reason for optimism, things that maybe people are missing that could go in their favor in 2024, and one thing that people aren't handicapping enough yet, something that could really hit people in the back of the head with a 2x4 that they don't see coming.
The optimism, to quote the great Rodney Atkins, if you're going through hell, keep on moving. Look at some of the biggest funds out there. How are they dealing with the fact that huge chunks of their portfolio is falling apart? They're raising their investing. It's just how it is, right? If you want to be in this business in a time of distress, you better have the emotional fortitude. You may better have the ability to deal with it. Pick the ones you want to save, pick the ones you want to dispose of, get yourself protected in every step of the process, and just keep on moving. Do deals. The optimism is that someone else is losing, and therefore you could get in at the right price. I hate to sound so crass, but that's the reality of it. The problem is that people are losing. So it's just a cycle. So do you want to be, I'm going to sound like a former president of ours, do you want to be a winner or a loser? Like literally that's the question, right? Do you want to wallow in your sorrow? Or do you want to take advantage and understand that economics means there's a buyer and a seller? There's a winner and there's a loser. And it seems like it's a zero-sum game, but it's not if you could play both sides. And that's the key thing moving forward, as far as I'm concerned. And that's what we're doing, right? Like we're looking and saying, like, where's the opportunity? Yeah, I think things are bad, but I've never been more positive and more excited in my life, in my short life. I've never been more excited than I am today, because I don't have to compete with someone's garbage business plan to some investor telling him how he's going to do crazy things for him. And I'm like, the guy's not legit. What do you mean he's not legit? He's giving me distributions for the last 3 months. I'm like, great. He's using the interest reserve for that. There's not, I don't have to compete with that anymore. I actually have opportunity to take my expertise and what I've done and go out there and make legit money. And that's something that the average individual needs to decide what they're doing. Do you want to sit there and wallow in your sorrow, or do you want to move forward and make something out of it? And it's the American dream.
I definitely want to be a winner. I don't know if I do. I want to be a winner, no doubt.
You are a winner in my book already.
Yeah, and I want the record. The record needs to reflect. I think we've had like 3 or 4 like optimistic takes from Shlomo in one setting. So like this has to be a record. So
do we have
so
it on
TreppWire...
tape? Do we have it on tape?
The TreppWire podcast turned Shlomo Chopp into an optimist. So yeah, we'll see how that flows. But I think this has been really great. I definitely appreciate the time, Shlomo.
And we already talked about your presence on Twitter and that you were at CREFC last year. So our listeners might be able to find you there again this year. But is there any other way or channel that our listeners can reach out to you if they want to ask questions or learn more?
Yeah, you can message me on Twitter, on LinkedIn. But if you do it, please don't try to fix my plumbing business on LinkedIn or try to sell me SEO services. But other than that, please feel free to reach out via direct message. I'm always ready to engage.
Awesome. Well, thank you so much for joining us today, Shlomo.
Thank you.
And with that, we'll close this special podcast. Thank you to our guest, Shlomo Chopp, for joining us today. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send an email to podcast@trepp.com. Until then, visit trepp.com for more info and subscribe to the TreppWire podcast with your favorite provider. Thank you for listening and stay well.
All right.